You've clicked on this video because you believe you can turn $100 into $1,000 in 1 hour. Here's the truth that will save your account. You can. It's mathematically possible. It happens every single day. But 97% of traders who attempt this exact goal will end the session with $23 left and a margin call notification blinking on their screen like a neon sign of failure. The difference between the 3% who succeed and the 97% who fail isn't luck. It isn't intelligence. It isn't access to better information or secret indicators. The difference is identity. It's who you believe you are when you sit down at that screen with your $100 and your dreams of exponential returns. Let me show you the brutal mathematics of amateur destruction that plays out every morning at 9:30. The amateur opens their platform with $100 burning a hole in their digital pocket. They scan for movers. They see momentum everywhere. Their brain starts calculating, if I spread this across 10 different trades, surely 1 or 2 will pay off big. That's how probability works, right? Diversify the risk. Increase the chances. Wrong. Catastrophically wrong. Here's what actually happens. They fracture their capital into 10 positions of $10 each. Each trade requires a stop loss, typically 5% below entry. That sounds manageable. Small risk, they think. But here's the mathematical death trap. With 10 positions, they're fighting a multi-front war. They're paying the spread 10 times. They're paying commissions 10 times. They're exposing their mental capital to 10 different sources of stress. Do the math. After slippage and transaction costs eat roughly 0.5% on each entry and exit, they need 9 out of 10 trades to either break even or win just to cover the losses from the one that hits the stop. That's a 90% win rate. The best hedge funds in the world, with armies of PhDs and supercomputers, don't achieve 90% win rates. But the amateur with $100 thinks they will. Now watch what the professional does with that same $100. They don't fracture it. They don't diversify it. They treat it as a single bullet in a sniper rifle. They hunt one trade in 60 minutes, not 10. They wait for a single confirmed setup where all conditions align perfectly. They risk the entire $100 on that position. But here's the critical difference. They structure it with a 1 to 10 risk-reward ratio. The amateur spreads their capital thin, hoping safety lies in numbers. The professional concentrates their capital like a laser, knowing that one perfect shot is worth more than 100 scattered attempts. This brings us to Jesse Livermore, the man many quietly call the greatest trader who ever lived. Livermore didn't become a legend by frantically clicking buttons all day. He didn't chase every wiggle on the chart. He became great by mastering the hardest skill in trading, doing absolutely nothing until the market begged him to act. He said, "It was never my thinking that made the big money for me. It was always my sitting." Most traders hear that quote and nod like they understand, but very few ask the real question. What was he sitting for? He was sitting for the pivotal point. That exact moment when the market, after hours of noise and fake moves, finally commits. The moment it stops asking questions and starts giving answers. The place on the tape where the line of least resistance becomes obvious to anyone trained to see it. The amateur never sees that moment because they're too busy reacting to everything else. The small spike here, the red candle there, the news headline popping up on their phone. Their attention is scattered across 5 charts, 3 social feeds, and 2 open positions they shouldn't be in. Here's what separates the 2 tribes, and this might be the most important distinction you'll hear today. Amateurs trade when they feel like it. They see movement. They feel that itch in their fingers, and they click buy. Fear of missing out drives their entries. Greed for quick profits. Hope that this one will be different. Professionals trade when the tape tells them to, not when they feel ready, not when they're excited, but when the market itself provides undeniable evidence that a move is beginning. Amateurs size positions based on confidence. I really like this setup, I'll go big. Then, on the next trade, I'm not sure about this one, I'll go small. Their position sizing reflects their emotional state. Professionals size based on one thing only: how much they can afford to lose, every single time. No exceptions. They calculate their risk first and size their position accordingly. Amateurs take profit at the first sign of green. The moment they see 50 cents of unrealized gain, panic sets in. What if it reverses? Better take it now while I can. They snatch pennies and miss dollars. Professionals pyramid into strength. When the market proves them right, they don't reduce their position. They add to it. They use the market's money to finance exponential returns. This is the fundamental paradox. The amateur wants to be right so badly that they take the small win just to prove they were smart. The professional doesn't care about being right. They care about the account balance. They know that one big win, fueled by pyramiding into a pivotal point, pays for 20 small losses. Let me paint you a picture. Imagine two traders side by side. Same $100 account, same 1-hour window, same stock on the screen. The first trader clicks within 3 minutes. Small candle up, volume spike, everyone screaming it's going. He grabs $10 worth, it pulls back. He buys another 10 on the dip, it drops more. He adds again to average down. Now he's in 3 positions, confused and stressed. By minute 40 he's taken 7 trades and is down $63. He starts doubling size, trying to get it back. At minute 60, he has $21 left and a story about bad luck. The second trader spends the first 30 minutes with their mouse nowhere near the buy button. Price is moving, sure, but it's messy. No clear structure, just noise. They watch, they mark levels, they read the tape like a book, looking for the one line that reveals the plot. At minute 32, they see it. A clean break of a level that held all morning, with volume 3 times higher than any previous candle. The path of least resistance declares itself. That is their pivotal point. The 1-hour entry formula isn't about finding more trades. It's not about being more active or more aggressive. It's about finding the one trade that makes all other trades irrelevant. The trade that turns your $100 into $1,000 through systematic identification of the exact moment when the market's hand is forced. But before you can identify that trade, you must master something that feels completely counterintuitive. You must get comfortable with boredom. You must get comfortable with silence. Because in that silence, the market speaks. If you're too busy clicking, too busy panicking, too busy trying to recover losses from the first 10 minutes, you will never hear what the market is telling you. The hardest skill in trading isn't reading charts. It's sitting on your hands while the market moves, watching the candles print, and having the discipline to say, "No, not yet. That is not my setup." You have to stop acting like a gambler at a slot machine, pulling the lever every time you see a light flash. You have to start acting like a predator, lying in the tall grass. The predator doesn't chase every gazelle. The predator waits until the prey is weak, until the distance is closed. The predator strikes once. In the next chapter, we'll explore why the first 30 minutes of your session should involve 0 trades, and how this waiting period transforms from a time of frustration into your greatest weapon, when everyone else is busy burning their $100 down to 23 before the real opportunity even appears. Every single blown account starts the exact same way. It begins with a trade taken in the first 10 minutes of the session. The scenario is always identical. You wake up, you check your watch list, and you see a stock gapping up. It's moving fast. The percentage gain is flashing green. You see it jump from 4% to 6% in seconds. You feel that tightness in your chest, that familiar cocktail of adrenaline and fear of missing out. Your brain starts calculating. If it's already up 6% and the day is just starting, imagine where it could go. You think, this is it. This is the runner. This is the one that changes everything. You click buy. For exactly 3 seconds, you feel like a genius. The stock ticks up another 15 cents. But then something shifts. The tape slows down. The green prints turn sparse, then red. Suddenly, a massive sell order hits the bid like a sledgehammer. The stock flushes down 50 cents in a heartbeat. You freeze. You don't sell because you're absolutely certain it will bounce back. It has to bounce back. It doesn't bounce back. It drops another 30 cents, then another 20. Your $100 has become $87, then 81, then 74. Panic floods your nervous system. You sell at $71 just to stop the psychological bleeding. You have just spent 3 minutes trading and lost 29% of your capital. Now you have to spend the next 57 minutes in a psychological prison, desperately trying to get back to even with the $71 you have left. You're no longer trading a plan. You're chasing your own tail, fighting your own emotions, making increasingly desperate bets with money you can't afford to lose. Stop. Right there. This is the pattern that destroys more trading accounts than any other single mistake. Not bad risk management, not over-leveraging, not even refusing to use stop losses. The silent killer is the inability to sit still during the first 30 minutes of the session. Here's what you must understand about market structure if you want to survive, let alone thrive. The first 30 minutes of any trading session belong to overnight orders, algorithmic programs unwinding positions, news reactions from people who just woke up and read a headline, and most crucially, emotional amateurs who cannot control their impulses. This is not your time. This is not your battlefield. This is the killing fields where small accounts go to die. When the bell rings at 9:30, chaos is unleashed. Market orders from retail traders who read a news headline the night before flood the system. Institutions use this liquidity to unload positions they've been holding overnight or to trap unsuspecting buyers. The volatility is violent, unpredictable, and for a small account, absolutely lethal. You're not trading against other retail traders during this time. You're providing liquidity to algorithms and institutional players who have been planning their moves since 4 in the morning. The opening 30 minutes are not for trading. They are for information gathering. They are intelligence reconnaissance. While the amateurs are hyperventilating and clicking buttons, burning through their capital like kindling, the professional is sitting back, coffee in hand, watching the carnage with cold detachment. They are not passive. They are aggressively observing, using this time to answer 3 critical questions that will determine the success of their entire session. Question 1. Where is the line of least resistance? Jesse Livermore spoke about this concept constantly. When the market moves, which direction does it move with conviction, and which direction does it struggle against? If every rally gets sold immediately, but every dip gets bought aggressively, the line of least resistance is up. The market is telling you that buyers are in control and sellers are weak. If rallies stick, but dips get crushed hard, the line of least resistance is down. You cannot know this at 9:31 when emotions are running wild. You can only know this after watching the battle play out for 30 minutes, after seeing who shows up with real conviction and who fades when tested. Question 2. What is the day's volatility range? You need to know exactly how much this particular stock is willing to move in a given candle. If the opening range is tight and compressed, with small candles and declining volume, you're looking at a coiled spring. When it breaks, it will move fast and far. If the opening range is wild, with massive candles swinging both directions, you're looking at chaos. Chaos is not tradable with a small account. You need structure, predictability, and clear levels that the market respects. Question 3. Where are the pivotal points that will define the session's direction? These are not random support and resistance lines drawn by some indicator. These are specific price levels that, once broken, will unleash a flood of momentum. A true pivotal point is a psychological barrier where bears give up and cover their shorts, or where bulls panic and liquidate their longs. You cannot identify a genuine pivotal point in the first 5 minutes. You need to see price test a level, reject it, test it again, and consolidate. You need the chart to draw you a map with clear boundaries. Here is your new protocol, and I need you to treat this like a law of physics, not a suggestion. Minutes 0 through 30 are for observation only. You watch the tape. You mark your key levels. You measure the opening range. You note where volume spikes and where it dies. You are a sniper lying in position, scope trained on the target, finger off the trigger. You are not a machine gunner spraying bullets at anything that moves. A machine gunner wastes ammunition, reveals their position, and usually misses the target. A sniper waits. They measure the wind. They calculate the distance. They wait for the target to stop moving. They take one shot, and it counts. Let me tell you about Marcus, because his story is probably your story, just not yet fully recognized. Marcus had a $150 account. Not huge, but meaningful to him. Every single morning, he followed the same deadly routine. He would scan for stocks that moved 5% or more in pre-market. The big movers, the ones everyone was talking about in chat rooms, the ones with the headlines and the momentum. I can't miss the move, he'd tell himself. If I wait, it'll be too late. The train will leave without me. So at 9:30 sharp, like clockwork, he would buy. Sometimes he'd catch a piece of the move and feel brilliant for 10 minutes, but mostly he would get caught in what traders call the morning wash. The stock would dip immediately after his entry, stop him out for a loss, and then rip higher without him. Or he would buy the absolute top of the opening spike, and it would fade relentlessly all day long. The result was a statistical disaster. 17 consecutive losing days. Not 17 losing trades spread across weeks. 17 losing days in a row. His $150 account bled down to 112, then 94, then 68, then 47. On day 17, he closed his platform with $31 left and genuine confusion about what he was doing wrong. Marcus wasn't stupid. He wasn't reckless with position sizing. He used stop losses religiously. He cut his losses when they hit his predetermined levels. But he was entering the battlefield at the exact moment when the enemy was at full strength, and his own forces were scattered and confused. He was charging into machine gun fire every single morning and wondering why he kept getting shot. Then we implemented one change. Just one. The 30-minute rule. No trades before 10 o'clock in the morning. Not usually no trades or try to wait. Absolutely zero trades before the 30-minute mark. If he placed a trade before 10, he had failed, even if he made money. His job was not to make money before 10. His job was to build a map of the battlefield. The first few days were psychological torture for him. He watched stocks fly up without him. He watched them crash down without him. He felt physical pain sitting on his hands while his brain screamed at him to act. But then, something remarkable happened. He started to see patterns he had never noticed before. He saw that the stock that ripped at 9:30 usually crashed by 9:45. He saw that the stock that sold off hard at the open often found a bottom around 9:50 and started a steady, clean climb right at 10 o'clock. Marcus realized that by waiting, he wasn't missing the move. He was avoiding the noise. He was letting the market reveal its true intentions instead of trying to guess them. He spent that first 30 minutes drawing his levels, watching the volume patterns, and identifying the exact price where the real move would begin. He stopped trying to predict the market and started reacting to what it was actually doing. The results were dramatic. His account didn't just recover, it exploded. He took that $31 and over the next 30 trading days built it to $412. Not because he suddenly got smarter or found better setups, but because he stopped playing the amateur's game. He stopped providing liquidity to professionals at the worst possible moment and started entering when the odds had shifted dramatically in his favor. Here's the secret that 97% of traders never learn. The best moves, the sustainable moves, the moves that can turn $100 into $1,000, rarely happen at the market open. They happen when the dust settles. They happen when the opening orders are cleared, when the weak hands have been shaken out, and when institutions begin to show their real cards for the day. The opening chaos is where amateur money goes to die. It's the liquidity that professionals use to enter their own positions at favorable prices. When you buy the high of the day at 9:32, you are literally handing your money to a professional who is shorting into your greed. Think about this from a pure game theory perspective. At 9:30, everyone is trading. Retail traders, algorithms, institutions closing overnight positions, market makers hedging their books. It's a crowd. In a crowd, you can't see clearly. You can't move freely. You're reacting to the person next to you, who's reacting to the person next to them. By 10 o'clock, the crowd has thinned. The people who remain are the ones with conviction, with real information, with actual capital to deploy. The moves that happen now have follow-through because they're not driven by overnight emotion or headline panic. You must completely reframe your definition of patience. Most traders think patience is passive, weak, about doing nothing. That perception is killing your account. Patience is not the absence of action. Patience is the timing of action. It is an active, aggressive state of mind. It is the ability to withhold your capital until the odds are so heavily stacked in your favor that losing becomes difficult. It is the discipline to stand on the sidelines while everyone else is getting slaughtered, keeping your powder dry, keeping your mind clear, and waiting for the specific set of conditions that signal the easy money is about to be made. Patience is a weapon. Every minute you wait while others are trading emotionally is a minute the market is revealing information that you can use and they cannot. You are gathering intelligence while they are burning capital. You are building your map while they are lost in the wilderness. So you have waited. You have watched the clock tick past the 30-minute mark. You have identified the trend, measured the volatility, and marked your pivotal points. You are sitting on your hands. Your heart rate is steady. Your mind is sharp. The amateurs have exhausted themselves. The real players are starting to show their hand. Now you need to know exactly when to strike. You don't just buy because it's 10 o'clock. You need confirmation. You need the market to sign a contract with you, to provide undeniable evidence that a move is beginning and that you're getting on board at the right time with the right risk parameters. In the next chapter, we'll transform that 30-minute observation period into a concrete battle plan. I'm going to show you exactly how to identify the 3 specific confirmation signals that must align perfectly within a 60-second window before you're allowed to risk a single dollar of your account. These signals will remove 90% of the guesswork from your entries and dramatically increase the probability that when you finally do pull the trigger, the market moves in your favor with enough conviction to turn your $100 into $1,000. You have waited 30 minutes. You have watched the chaos burn itself out while amateurs torch their accounts chasing opening volatility. You have resisted every urge to click buy just because something moved. You have observed, measured, and marked your levels. Now comes the moment that separates professionals from gamblers forever, knowing exactly when the market is begging you to trade. This is where the 2 tribes part ways for good. The amateur needs just one excuse to enter. A green candle, a level break, a tweet from some guru. Any single signal becomes their justification. Price ticks above yesterday's high by 2 cents. They're in. A red to green reversal on the 1-minute chart. They're buying. It doesn't matter that volume is dead. It doesn't matter that it's a low participation time of day. They see one piece of evidence and build an entire fantasy around it. The professional is the exact opposite. One signal is never enough. One piece of evidence doesn't move real money. Professionals act only when the market tips its hand so clearly that saying no feels harder than saying yes. For them, entry requires 3 signals, all aligned within a tight 60-second window. Not over an hour. Not over 20 minutes. Inside 60 seconds. Price structure, volume surge, and time window. If any one of those is missing, there is no trade. The gun stays holstered. This is the core of the 1-hour entry formula. This is how you transform that information gathering period into a sniper shot instead of another random gamble. You are not a machine gunner spraying bullets at anything that moves. You are a predator lying in wait, and when these 3 signals align, you strike once with devastating precision. Signal 1, price structure. By the time you reach the 30-minute mark, the market has drawn you a map. That map is made of levels where price has repeatedly bounced, stalled, or reversed. A professional does not trade in the middle of nowhere. They trade at the edges of structure, where tension has been building and is ready to explode. You need a clear, undeniable break above a defined pivot level. This cannot be some arbitrary line you drew because it looked good. It must be a level that the market itself has validated through repeated testing. The 3 most reliable pivots are the prior day's high, the opening range high, or most powerfully, a consolidation range that is held for at least 20 minutes. Think of price consolidation like compressing a spring. The longer the market squeezes price into a tight range, the more energy is being stored. When a stock trades between 48.50 and 49.20 for 5 minutes, it's just a range. When it spends 30 or 40 minutes respecting those exact boundaries, it becomes a battlefield. Every time price hits 49.20 and pulls back, sellers are defending that level with their capital. Every time it hits 48.50 and bounces, buyers are stepping up with real money. This is not random movement. This is a trench war, and the longer that war continues, the more explosive the eventual breakout becomes. When one side finally breaks, the move will be violent. All the traders who were betting against the breakout direction suddenly realize they are wrong. Shorts have to cover. Breakout traders pile in. Momentum algorithms trigger. The stored energy releases like a coiled spring snapping free. If price is just drifting upward without a clear level to break, there is no tension. There is no stored energy. That's just noise. And noise is where small accounts get chopped to pieces. You want the explosion that comes from a broken consolidation, not the drift that comes from random movement. Signal 2. Volume surge. Price without volume is a rumor. A stock can break through any level on light volume, but without participation, that breakout is meaningless. Volume is the lie detector of the markets. Price can be manipulated by a single large order in a thin market, but volume represents the actual exchange of shares, the voting mechanism of the market where participants put their money where their conviction lies. The rule is mathematically strict. The breakout candle must show volume at least 200% above the 10-period average, not 150%, not 180%, 200% minimum. This is non-negotiable. Here's how you measure it practically. Look at the volume bars on your chart. Eyeball the average height of the last 10 bars. When your breakout candle prints, its volume bar should be at least twice as tall, ideally 3 or 4 times as tall. If you want to be precise, calculate the 10-period volume moving average and multiply by 2. That's your minimum threshold for a valid breakout. Why is this so critical? Because when you see light volume on a breakout, the market is whispering, "I'm not really committed to this move. I might change my mind in 30 seconds." That whisper is where amateurs get trapped. They see the price break and think, "It's going now. I can't miss it." Then they watch the move die 2 candles later as price drifts back into the range. But when you see that volume explosion, when volume spikes to 300%, 400%, 500% above the average, the market is not whispering anymore. The market is screaming. It's saying every buyer who was sitting on the sidelines just jumped in at once. Every short seller is panicking and covering. Institutions are stepping in with size. This move has conviction, and conviction creates follow-through. Signal 3. Time window. Most traders completely ignore timing, but time is a filter just as powerful as price and volume. Markets operate on rhythm. There are times when moves are genuine, and times when they are fake. Certain periods attract certain types of participants, and your breakout must occur when the right players are active. For your 1-hour formula, the highest probability time window is the final 30 minutes of your session. If you started observing at 9:30, this means 10 o'clock to 10:30. If you started at 10, this means 10:30 to 11. This is when the morning volatility has settled, when the market has chosen its direction, and when institutional money makes its directional bets for the rest of the session. Why does timing matter so much? Because by 10 o'clock, the amateur hour is over. The algorithms have finished their morning liquidity sweeps. The emotional reactions to overnight news have played out. Now institutions are stepping in to establish their positions. When you see a breakout during this window, you are potentially aligning yourself with institutional flow instead of fighting against retail panic. A breakout at 9:40, when the market is still shaking out weak hands, is not the same as a breakout at 10:45, when real money is making real decisions. If your perfect-looking setup appears during a dead zone, you ignore it. It does not meet your criteria. The discipline to let a seemingly perfect setup pass because it fails one of your 3 criteria is what separates you from the amateurs who are still broke. Now let's synthesize all 3 signals with a concrete example that shows you exactly what this looks like in real time. It's 10:47 in the morning. You have been observing StockXIs since 9:30, honoring the 30-minute rule religiously. The stock opened at $48, spiked to 50 on opening volatility, then settled into a grinding consolidation between 48.50 and 49.20. For 38 minutes, this range has held like a steel cage. Price has tested 49.24 separate times and been rejected each time by sellers defending that level. It has tested 48.50 3 times and bounced each time as buyers stepped in. The range is getting tighter. The volume on each successive test is declining. The spring is compressing. You can feel the tension building on the screen. You mark 49.20 as your upper pivot and 48.50 as your lower pivot. You know a break of either level, with proper confirmation, could unleash a powerful move. You also identify your pivotal point at 48.45, just below the consolidation range. That's the level that, if broken, invalidates the entire thesis that buyers are in control. Then, at 10:47 and 32 seconds, it happens. A 1-minute candle opens near 49.10. Buyers hit the ask aggressively. Price rips through 49.20 like it was tissue paper, then 49.30, then 49.40. At the exact same moment, you glance at your volume display. It's not just higher. It's massive. 340% of the 10-period average. More than triple the activity of any previous candle in the entire morning. You now have signal 1. A clean break of a well-defined pivot after a 38-minute consolidation. Signal 2. A powerful volume surge proving the market cares deeply about this move. Signal 3. It's happening inside your high-probability time window, when institutions are making their directional bets. This is your moment. This is not just a breakout. This is the market tipping its hand. The line of least resistance has shifted decisively upward, and you have evidence from price, volume, and time all screaming the same story. The 3 tumblers in the lock have clicked into place simultaneously, but before you click buy, you must define where you will be proven wrong. Your pivotal point is 48.45, below the consolidation range. If price somehow reverses, falls back through the entire range, and breaks 48.45, your thesis was completely wrong. Not partially wrong, not needs more time to develop, just wrong. When that happens, you don't argue with the market. You don't hope. You don't average down. You exit immediately. This is the discipline that separates professionals from addicts. Professionals define their invalidation point before they enter and honor it religiously. They know that being wrong is a cost of doing business, but staying wrong is a path to ruin. You must understand the scarcity of this moment. The market does not provide these perfect setups all day long. In a typical session, you might see this alignment of price structure, volume surge, and time window only once, maybe twice. Sometimes, not at all. The market only gives you 1 or 2 perfect setups per session. Miss them because you were chasing noise, and you've wasted your hour. Catch them, and you've captured lightning in a bottle. This 3-signal confirmation framework does 2 critical things for your survival. First, it forces you to slow down and wait for genuine alignment, which instantly eliminates most of the low-quality trades that drain accounts. Second, it gives you a repeatable mechanical process. Instead of guessing based on emotions, you ask 3 simple questions. Do I have structure? Do I have volume? Am I in the right time window? If the answer is not a clear yes to all 3, you do nothing. Waiting becomes your default state. Action becomes the rare exception. But let's be brutally clear about something. Identifying the right setup is only half of the equation. A perfect entry with reckless position sizing can still destroy you. A flawless breakout with no understanding of risk management will turn into just another spike on your equity curve, followed by another devastating collapse. The next step is where professionals truly separate themselves from gamblers. How much they risk, how they scale into positions, and how they use the market's own money to pyramid into strength without ever jeopardizing the survival of their account. In the next chapter, we're going to break down the precise mathematics that allow you to translate this one perfect setup into a position size that keeps your downside tiny while leaving the upside open enough that when you catch one of these lightning moves, your $100 can realistically expand toward 1,000 without ever betting the farm on a single trade. You have identified the perfect setup. All 3 signals have aligned within a 60-second window like tumblers clicking into place in a vault. Price has shattered through a well-defined pivot after 38 minutes of consolidation. Volume has exploded to 340% of the average, screaming institutional participation. The time window is perfect. Your finger hovers over the buy button, adrenaline starting to spike through your nervous system. Now comes the single moment that separates professionals from gamblers forever. Now comes the question that determines whether you will be trading next month or explaining to your spouse why the account is empty. How much do you risk? This is where the amateur's brain short-circuits completely. They look at this beautiful setup, this perfect alignment of signals, and their internal voice screams, "This is it." This is the one I've been waiting for. This looks exactly like that setup I saw make someone rich on social media. I need to go big here. If I only risk a little, I won't make enough to matter. I need to double my account today. So they take their entire $100 account and shove it into this single trade, betting everything on being right this one time. The professional looks at that exact same setup with that exact same conviction and thinks something completely different. Their internal voice says, "This looks fantastic, but I have been wrong before, and I will be wrong again. The market does not care about my analysis. The market does not care about my confidence. My job is not to be right. My job is to still be here tomorrow if I'm wrong today." So they size based on cold mathematics, not burning emotion. Here is the formula that will protect you from ruin. This is the only holy grail that exists in trading. Memorize it. Burn it into your memory. Make it as automatic as breathing. Position size equals account size multiplied by risk percentage, divided by stop distance. Let me break this down with your actual numbers so you can see the mechanics of survival. You have a $100 account. You have established a hard rule that you will never risk more than 2% of your capital on any single trade. This is not a suggestion. This is law. 2% of $100 is $2. That is your maximum allowable loss on this trade. If the thesis fails completely, if the market laughs at your analysis, you lose exactly $2 and have $98 left to fight another day. Now look at your chart. You have identified your entry point at the breakout level of $49.20. You have identified your pivotal point, the level where your thesis is proven wrong, at $48.45. That is a distance of 75 cents on a 49.20 entry, which equals approximately 3%. This is your stop distance. Apply the formula. $100 multiplied by 0.02 divided by 0.03. That calculation gives you $66.67. Round it to $67. That is your position size. I need you to understand what just happened here, because this is where beginners get confused and professionals get rich. You are buying $67 worth of stock, but you are not risking $67. You are risking exactly $2. If the price drops 3% to your pivotal point, your $67 position loses $2 of value. You sell immediately, and you have $98 left in your account. You are still alive. You are still in the game. You can be wrong 10 times in a row, a statistical improbability if you are following the 3 signal entry rules, and you would still have roughly $80 left. You have removed the fear of ruin from the equation. When you remove the fear of ruin, you remove the emotional panic that causes catastrophic decisions. You can watch the trade breathe without your heart pounding because you know, with mathematical certainty, that the worst-case scenario is manageable. But you did not come here to protect $2. You came here to turn 100 into 1,000. Safety is the foundation, but controlled aggression is the engine. How do we generate exponential returns from such tight risk parameters? We use the most powerful weapon in the professional trader's arsenal, pyramiding. The amateur buys their full position size all at once. They shove all their chips into the middle of the table and pray to the trading gods. The professional treats the initial entry as a probe, a reconnaissance mission. They are asking the market a question: am I right about this move? And they wait for the market to answer with cold hard cash before they commit their full firepower. You do not deploy all $67 at the initial breakout. You start with $30 at $49.20. This is your scout position. If the price immediately reverses and hits your stop at $48.45, you lose roughly 85 cents, which is less than 1% of your total account. The cost of finding out you were wrong is negligible. But let's say you are right. The price breaks $49.20 with that volume explosion and continues higher. It moves to $50.20, a 2% advance, and holds that level for at least 5 minutes. The market has answered your question. It has said, yes, you are right. Buyers are aggressive here. This move has legs. Now, and only now, do you press your advantage. You add the remaining $37 to your position at $50.20. But simultaneously, you do something critical for your survival. You move your stop loss on the first $30 position up to $49.20, your original entry price. That first position is now risk-free. Think about the mathematical beauty of what just happened. You now control a $67 position, but your actual risk has not increased. In fact, it has decreased. The first $30 cannot lose money because your stop is at break-even. Your only risk is on the second position, and even that risk is smaller than your original calculation because you added at a higher price with a tighter stop. You are now using the market's money to finance your aggression. You are playing with house money while the house is betting against itself. This is exactly how Jesse Livermore built his legendary positions that made him $100 million in 1929. He famously said, "I never buy at the bottom, and I always sell too soon." What did he mean? He meant that trying to catch the exact bottom is a fool's game built on hope and guesswork. Buying at the bottom means you are buying while price is falling, hoping it stops falling. Livermore bought when price was rising. He bought strength and added to strength. He waited for the market to prove his thesis correct, then he pyramided relentlessly into that confirmation. When you pyramid correctly, the mathematics become absolutely beautiful. Let's walk through a complete scenario so you can see the exponential power. You enter $30 at $49.20. The stock moves to $50.20 and holds. You add $37. Your average entry price is now approximately $49.70. You move your stop on the first position to break even. The stock continues higher, reaching $54. That is roughly a 9% move from your average price. Your total $67 position has made you approximately $6. You risked $2 maximum. You made $6. That is a 3-to-1 reward to risk ratio on a single trade. But this is conservative. When you catch a genuine institutional breakout during the optimal time window, moves of 15 to 20% are common, not rare. If that same stock reaches $56.58, a 15% move from your average entry, your $67 position makes you approximately $10. You risked $2 to make $10. That is a 5-to-1 reward to risk ratio. Your $100 account is now $110. One trade, 1 hour, 10% return on your entire account, while risking only 2%. This is the mathematics of exponential returns, and it works because you are capturing asymmetric outcomes. When you lose a teaspoon. When you win, you fill a bucket. The amateur risks big to make small. They bet their entire account trying to scalp pennies, exposing themselves to total ruin for tiny gains. The professional risks small to make big. They bet pennies to make dollars, and they only add more pennies when the dollars start showing up on the screen. But here's the trap that destroys even disciplined traders. When the math works, when the pyramid builds, when you see your account jump from 100 to 110, then 120, then 150 in a single session, a chemical reaction occurs in your brain. Dopamine floods your system like a drug. You feel invincible. You feel like you have cracked the code. That voice in your head whispers, "If I can make $10 risking 2%, imagine what I could make risking 10%. Imagine if I pyramided twice as much. Imagine if I found another setup right now and did this again." The moment that thought enters your consciousness, you are in mortal danger. The mathematics of exponential returns cuts both ways. It can build wealth like compound interest, but if you abandon the risk management foundation, it will destroy that wealth like a house of cards in an earthquake. You must understand that the formula works precisely because of the constraints, not in spite of them. The 2% risk limit is not holding you back. It is the engine of your survival. The disciplined position sizing is not limiting your profits. It is ensuring you live to collect them. We have covered the entry signals. We have covered the mathematical sizing. We have covered the pyramiding mechanics. You now possess the technical framework of a professional trader. But technical knowledge without emotional discipline is like a Ferrari with no brakes. It will get you moving fast, but it will not get you where you want to go. The hardest part of the 1-hour entry formula is not identifying the setup. It is not calculating position size. It is not even executing the pyramiding. The hardest part is knowing when the party is over. When your account has grown from 100 to 300, 400, even $800 in a single session, every instinct in your body will scream at you to keep going. to find another setup, to press your luck just one more time. In our final chapter, we will address the exit protocol. I will show you exactly how to identify the specific market signals that scream the move is exhausted, and more importantly, how to walk away from the table with your exponential gains intact before the inevitable reversal turns your $1,000 winning session back into a $100 disaster. Because in the end, making money is only half the battle. Keeping money is what separates the professionals from the cautionary tales. You have executed with surgical precision. Every element of the 1-hour entry formula clicked into place like tumblers in a vault. You honored the 30-minute waiting period while amateurs incinerated their accounts. You demanded 3-signal confirmation before risking $1. You sized mathematically, pyramided into strength, and watched your $100 transform into $847 in 53 minutes. You are experiencing something that 97% of traders never feel: the intoxicating rush of exponential returns. Your heart pounds against your ribs. Your hands tremble slightly as you stare at numbers that feel surreal. You have just made more money in 1 hour than many people earn in a week. Every cell in your body vibrates with a mixture of euphoria, disbelief, and raw adrenaline. Then, like a serpent whispering in your ear, a voice slithers into your consciousness. This is incredible, but why stop now? If I can turn 100 into 800 in 1 hour, imagine what I could do with 2 hours. Let's make it 2,000. I've cracked the code. I've figured this out. Stop. Right there. Recognize that voice for what it is, the most dangerous moment in your entire trading career. This is not confidence speaking. This is not skill or intuition. This is dopamine hijacking your prefrontal cortex and convincing you that you are invincible. After a massive win, your brain floods with dopamine, the same neurotransmitter that makes cocaine addictive. This chemical bath does 2 things with ruthless efficiency. It makes you feel invincible, and it makes you systematically underestimate risk. You start seeing setups that don't exist. Every chart begins looking like the perfect entry. You lower your standards without realizing it. A weak volume spike suddenly looks like institutional buying. A random breakout suddenly appears confirmed. You begin believing you have transcended the rules that govern mere mortals. This neurochemical hijacking has destroyed more accounts than bad risk management, poor entries, or lack of knowledge combined. The 1-hour entry formula has a hard stop at 60 minutes for one reason, not because opportunities disappear, but because your judgment does. This is where professionals separate from addicts forever. Let me remind you of Jesse Livermore, because his story is the ultimate warning. Livermore was arguably the greatest tape reader who ever lived. He made $100 million in 1929, equivalent to billions today. He understood market psychology better than anyone before or since. And yet he went bankrupt 4 times. Not once. 4 times he built massive fortunes, and 4 times he lost everything. Why? Not because he forgot how to read the tape. Not because he lost his mathematical edge. He destroyed himself because he couldn't control his own psychology after massive wins. When his account was exploding and everyone called him a genius, he would immediately start hunting for the next trade, the next conquest, the next dopamine hit. He would abandon his own rules, size too large, trade outside his optimal conditions. The market, patient and merciless, would eventually collect everything. If Livermore, with all his genius and experience, couldn't trade through euphoria without destroying himself, what makes you think you can? You need a protocol that removes discretion from the equation. You need rules that you follow, especially when every fiber of your being wants to break them. Here's your exit protocol. It consists of 3 non-negotiable elements that will save you from yourself. Element 1, the climax signal. The end of a great move rarely looks like weakness. It usually disguises itself as the greatest strength of the entire session. You must watch for a specific pattern that signals exhaustion, massive volume spikes accompanied by minimal price progress. This is what it looks like. Your stock has been climbing steadily, green candle after green candle, each supported by healthy volume. Then suddenly, a 1-minute candle prints with volume 3 times higher than the previous bar. But look at the price action. The candle barely moves. Maybe it advances only 10 or 15 cents on triple volume. Maybe it has a long upper wick showing rejection at higher prices. This is churning. This is the market screaming that every buyer who was waiting on the sidelines just panicked and bought simultaneously. But there weren't enough willing sellers at higher prices to absorb all that demand, so price stalled. When everyone is desperate to buy what you already own, that is your signal to exit. You don't wait for confirmation. The confirmation will be a red candle, and by then much of your profit will evaporate. You sell into the euphoria, not after it ends. Element 2, the time stop. At the 55-minute mark of your 1-hour window, regardless of profit or loss, regardless of whether the trade is still working, you begin your exit process. No exceptions, no negotiations, no just 5 more minutes to see if it breaks this level. The 5-minute buffer gives you time to execute properly rather than rushing at the 60th minute. More importantly, this boundary trains your brain that trading is a job with defined hours, not a casino that operates 24/7. The formula works precisely because it has constraints. Without boundaries, you're just gambling until you hit zero. After 60 minutes of intense focus, especially following a large gain, your decision-making quality degrades rapidly. You become more impulsive, more emotional, more likely to give back what you just earned. The time stop protects you from this psychological deterioration. Element 3, the walk-away rule. This is the hardest rule to follow, and the most critical for survival. Once you exit your position, you immediately close your trading platform. Not minimize it, not switch to a watch list. You shut it down completely. You physically leave the trading environment. Why? Because if you stay, you will look. If you look, you will see the stock move another few percent and feel regret about leaving money on the table. That regret will drive you to jump back in, usually right at the top. Or you'll see the stock crash and think you should short it, entering a revenge trade that wipes you out. You must protect your mental capital as fiercely as your financial capital. Let me walk you through a complete scenario. It's 10:54 in the morning. Your pyramided position has exploded your account from $100 to over $1,200. You're feeling euphoric, invincible. Then you see it, a massive 1-minute candle, with volume spiking to 340% of the average, but price only moves from $56 to $56.12, 12 cents on explosive volume. That's your climax signal. You don't hesitate. You don't hope for one more push. You sell immediately, exiting at an average of $56. Your account settles at $1,247. You close the laptop. You walk away. The next day, you discover the stock topped 18 cents higher than your exit, then collapsed 8% by day's end. Everyone who held through that climax signal gave back their gains and more. But you kept everything because you followed the protocol. The market's job is to take your money. Your job is to not let it. Here's your complete actionable framework. First, wait 30 minutes before considering any trade. Let amateurs destroy themselves while you gather intelligence. Second, demand 3-signal confirmation. Price structure, volume surge, and time window must align within 60 seconds. All 3 signals, or no trade. Third, risk exactly 2% of capital, calculated mathematically based on stop distance. Pyramid only when the market proves you right. Moving stops to break even immediately. Fourth, exit at the climax signal or 55-minute mark, whichever comes first. Sell into strength, not weakness. Fifth, walk away and protect your mental capital. Close the platform, leave the room, preserve your emotional state for tomorrow. The difference between $100 and $1,000 isn't finding perfect trades. Perfect trades don't exist. The difference is having the discipline to execute imperfect trades perfectly, following a systematic process that accounts for both mathematical realities and psychological traps. You now possess the complete framework of professional trading. But knowledge without discipline is worthless. The formula only works if you work the formula. You must practice this system, internalize these rules, and build the discipline to follow them when your emotions scream otherwise. If you have mastered this formula, if you can wait, confirm, size, pyramid, and exit with mechanical precision, you're ready for the next level. The next lesson will show you how to identify these setups before they happen, reading volume precursors and institutional footprints that reveal the move building before price even breaks. You'll learn to see what professionals see before amateurs know a move is coming. But that lesson is for traders who have proven they can follow systematic processes. Master this formula first. Prove you can execute with discipline. Then you'll be ready to see the market through professional eyes.